Welcome back to AlgoBot, the channel where we take automated trading strategies apart and study exactly how they think. I'm your host here at AlgoBot, and today we're examining an expert advisor for MetaTrader 5 called Bump Run Reversal. It's an automated read of a classic chart pattern first described by Thomas Bulkowski. Over the next few minutes, you'll learn how this strategy maps a gentle background trend with a regression line, how it detects an emotional overextension away from that line, and how it waits for price to reclaim the line before acting. Everything here is educational information only, so let's get started. Let's start with the big picture. Bump Run Reversal is built on a simple, very human observation about markets. Prices often drift along a calm, orderly trend, and then a burst of one-sided emotion pushes them far away from that trend in a hurry. Bulkowski called the calm phase the lead in, and the emotional surge the bump. His insight was that these overexcursions tend to be unsustainable. Once the last eager buyers or sellers are spent, price rolls back and runs the other way, usually recrossing the original lead-in line. This strategy tries to study and act on that rollback. To do that objectively, the expert advisor works on a single time frame and uses three ingredients. First, it fits a least squares regression line over the most recent block of closed bars. That line is the spine, and its slope describes the gentle background trend. Second, it measures how far price has stretched away from the spine over the most recent slice of the window, comparing that stretch to the average true range. When the stretch reaches a set multiple of ATR, an emotional bump is present. Third, and this is the important discipline, it does nothing until price actually closes back through the spine. That reclaim is the confirmation that the run has begun, so the strategy is never trying to catch a still falling market mid-drop. Who is this style aimed at? Educationally speaking, it suits a trader who is curious about mean reversion after overextension and who prefers a defined, mechanical bracket around every position rather than discretionary management. It's naturally at home on a liquid instrument like a major currency pair, a metal, or an index, on the 15-minute to 1-hour charts, where orderly trends punctuated by emotional spikes are common. As always, trading carries real risk, and losing trades are a normal part of any approach. Now let's walk through the exact logic, step by step. Everything is evaluated once per newly closed bar, so the strategy is patient and never reacts to an unfinished candle. The first step is the lead-in. The expert advisor takes the last 40 closed bars, that's the LeadPeriod parameter, and fits a least squares regression line through their closing prices. This line is the spine. Its slope tells us the direction of the gentle background trend, and the fitted value at the most recent bar gives us the current reference level. The second step is the bump. Using the average true range over 14 bars, the strategy sets a bump distance equal to bump ATR multiple times ATR, which defaults to 2 times ATR. It then scans the most recent slice of the window, roughly the last third of it, and finds the furthest a high has stretched above the spine and the furthest a low has stretched below it. If the largest stretch reaches that bump distance, an emotional overexcursion has been recorded. The third step is the reclaim, and this is what actually signals an entry. For a short, the strategy detects a rising lead-in, a bump above the spine, and then the freshly closed bar closing back below the spine after the previous close was on or above it. That fresh cross downward through the line signals a sell. For a long, it detects a falling lead-in, a bump below the spine, and the freshly closed bar closing back above the spine after the previous close was on or below it. That fresh cross upward signals a buy. Risk is deliberately tight for a lower drawdown profile. On entry, the protective stop is placed StopAtrMult multiple times ATR beyond the entry, defaulting to 1.2 times ATR. The take profit sits at RewardRisk times that stop distance. So with the default of 1.8, the target is 1.8 times the risk. Once price moves break-even R times the risk in your favor, that's 0.8 times risk by default. The strategy pulls the stop to the entry price, aiming to protect the position. Only one position per magic number is held at a time, and the bracket manages every exit. The strategy also skips new entries when the spread is wider than max spread points, 60 points by default, to avoid poor fills. Let's read the actual MetaTrader code the expert advisor runs. At the top are the inputs. LeadPeriod is the 40-bar regression window that builds the spine. Bump ATR multiple, defaulting to 2, is how far price must stretch from the spine in ATR units to count as a bump. ATR period feeds both the bump gauge and the stop. Stop ATR multiple, reward risk, and break-even are shaped the risk bracket and max spread points, lots, and magic round out the settings. Now the short block. The condition bump top is true when the slope is positive, a rising lead in, and the largest upward stretch reaches the bump distance. The condition cross down is true when the previous close was on or above the spine and the current close is below it, that fresh cross back through the line. When both are true, the strategy reads the bid as the entry, sets the stop distance to StopAtrMult multiple times ATR, places the stop above entry, and sets the take profit at reward risk times that stop distance below entry. It then calls trade.sell with those levels. The long block mirrors it exactly. Bump bottom needs a negative slope, a falling lead in, and a downward stretch reaching the bump distance. Cross up needs the previous close on or below the spine and the current close back above it. When both hold, the strategy takes the ask as entry, places the stop below entry, sets the take profit at reward risk times risk above entry, and calls trade.buy. Both sides use the same tight, symmetric bracket. Let's bring this to life on the chart. The blue line running through the candles is the lead-in spine, the least squares regression line fitted over the last 40 closed bars. Watch how price behaves around it, because that relationship is the whole strategy. We'll start on the left with a short setup. The first few candles drift gently higher, and you can see the spine sloping upward alongside them. This is the calm lead-in, an orderly rising background trend. Then something changes. On the fourth and fifth candles, price surges. A burst of buying pushes the highs well above the spine, stretching far away from that fair value line. This is the bump, the emotional overextension. The strategy measures the furthest high above the spine and compares it to the average true range. Here that stretch clears the bump threshold of 2 times ATR, so a valid bump above the spine is now recorded. But notice the strategy does not act yet. It refuses to sell into a still rising market. Instead, it waits for the reclaim. On the very next candles, the surge fails. Price rolls over, the high candle gives way, and the close falls back toward the line. On the eighth candle, the close finally drops back below the spine after the previous close was above it. That is the fresh cross downward, the confirmation that the run has begun. At that point, the sell entry marker appears. The strategy reads the bid, places its protective stop a little more than 1 ATR above the entry, and sets the take profit at 1.8 times that risk below entry. From there, price runs lower, candle after candle, until it reaches the take profit marker. This short sequence has completed with the target met, and the reward was set to be larger than the risk taken. Now the picture flips for a long setup on the right side of the chart. After the reversal, price keeps sliding and the spine now slopes downward, describing a gentle falling lead-in. Then, on the 12th and 13th candles, selling accelerates hard. The lows plunge well below the spine, printing a fresh low and stretching far beneath the fair value line. That is a bump below the spine, and again the downward stretch clears the 2 times ATR threshold, so the bump is confirmed. And once more, the strategy stays patient. It will not buy while price is still falling. It waits for price to reclaim the spine from below. On the 14th candle, the market snaps back. The candle closes back above the spine after the previous close was beneath it, a fresh cross upward. That is the buy entry. The strategy takes the ask, places its stop a little more than 1 ATR below entry, and sets the take profit at 1.8 times that risk above. Price then pushes higher into the final candle and reaches the take profit marker. If, along the way, either trade had first moved 0.8 times its risk and profit, the stop would have been pulled up to the entry price to protect the position. So in both directions the logic is identical and symmetric. Map the trend with the spine, wait for an emotional overextension away from it, and only act on the reclaim back through the line, never before. That discipline, entering on the confirmed run rather than the falling knife, is the heart of the bump run reversal approach. Remember, this is an illustration for learning, and real markets will not always follow the pattern so cleanly. That brings us to the end of our look at bump run reversal. We covered how it fits a regression spine to map the lead-in trend, how it gauges an emotional bump away from that line using the average true range, and how it only acts on the reclaim when price closes back through the spine. We also walk through the tight ATR stop, the reward to risk take profit, and the break-even lock that manages every trade. Remember, this video is educational content only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losing trades are a normal part of the process. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to study next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.